Hello friends, in our regional channel we recently conducted a poll. How to destroy wealth? Weird question, right? The options were gambling, lottery, horse racing, investing in ULIP endowment plans or guaranteed money back plans. 50% of people said investing in ULIP or endowment plans will actually destroy your wealth. This might be weird for people who do not know about these plans, but this is the sad truth of these plans. In fact, our family was a victim to this kind of investments. In 2007, when my parents went for a housing loan in a bank, the bank manager said it is mandatory to buy a ULIP, and without which housing loan will not be sanctioned. Without a good financial literacy and awareness, my parents were tricked into it, and we withdrew the money at a loss of 15,000 rupees in 4 years. I was actually happy that we withdrew in just before the end of the tenure, because we might have ended up, going for more losses. These ULIPs and endowment plans are one of the most commonly used investment options under Section 80C, primarily because these agents and the sales executives actually trick people into it, and more people fall into this trap. So in today's video, we will discuss about these plans in detail and why these are not good investment options. We will also discuss about how salespeople will really trick you into it and what are the right questions that you will ask. And towards the end of the video, we will give you a set of to-dos which you must follow to prevent yourself from falling into this trap. Before we get started, a brief disclaimer. We are not tax experts or investment experts or insurance experts. This video is purely for educational and informational purposes. Please do your own research. Now let us understand the first plan, insurance linked or endowment plan, money back plan or guaranteed return plan, whatever you may want to call it. Several private companies and even the PSU insurers, not PSU, Life Insurance Corporation of India, they also provide this product. There are two components in this product. Number one is the investment component, which actually gives you the returns, and second is the insurance component that covers your life insurance. Now let us look at it part by part. First, the investment option. Generally, the construct of this plan is like this. For a first few set of years, you'll pay every year a fixed amount, and there will be a break in between, and after which every year you get a guaranteed return or a guaranteed return plus bonus, or at the end of the year, end of the tenure, you will get a lump sum amount, right? This is generally the construct of the plan, and different plans follow different amount and different returns are being given. What I did is I actually called up one of the famous insurer via telecalling, and they explained some of their products and the construct behind it. Let me explain you one of those products. In fact, two of those products. One of those products, it's one of the best sellers. The construct is as follows. For the first 10 years, the individual must pay 1 lakh rupees, and at the end of the 20th year or at the beginning of the 21st year, as you may call it, you will get an amount of 22,72,000 rupees. Wow, this looks like an amazing return, right? The money literally doubles. Yeah, that's how I also perceived it in the beginning. But there are some nuances to it which you must understand. Number one, if someone is asking you pay rupees 1 lakh in this guaranteed return plan, which is insurance linked, you must also understand there is a GST associated with it, and they generally do not tell till the time of payment. So if you are really paying 1 lakh rupees, the total amount that you will have to pay is much more than that. For instance, in the first year, you will have to pay 4.5% extra, and in the subsequent year, you will have to pay 2.25%. So my total investment in the first year is 1,04,500 rupees, and from the second year onwards, it's 1,02,250 rupees. So if I am paying 1,04,500 rupees, 4,500 rupees will go to GST, and only the remaining amount goes to this plan as an investment or an insurance premium, right? Now, let us look at the returns that you are going to get. So in this plan, while you will not get any returns till the 20th year, at the end of the 20th year, you are getting a lump sum amount. Let us understand this. Let us understand the actual returns. To understand the actual returns, it's very simple. You need to do a simple calculation in Excel, which is called the IRR formula. So for that, what you need to do, every year you need to indicate what is the amount that is going out of your pocket or that is coming into your pocket, and then you'll have to apply this formula. For instance, from year 1 to year 10, there is a net outflow of 10 lakhs plus the GST amount, correct? So I have indicated every year how much is going out, and at the end of the year I have indicated how much amount is coming in. For amount that is going out, I have put a negative symbol as an indication that it is going out, and for the amount that is coming into my pocket, I have indicated a plus symbol. Now let us calculate the IRR. Yeah, IRR means internal rate of return. So if you look at the internal rate of return of this particular product, as you can see, it is just 5.2%. Look at FDs. Few months back, we were getting FD returns of around 6%. 5.2% is nowhere closer to a good return. Let us compare this with PPF, right? PPF, the lock-in period is 15 years and you can still extend it. Let us say you follow the same construct. You invest 1 lakh every year in PPF. If you invest 1 lakh every year in PPF, and let's say you don't invest from 11th year to 15th year, well, you must invest, but just for the example, if you don't invest, at the end of 20th year, you will get 29,52,000 rupees, because the guaranteed returns in PPF is around 7.1% and there is no GST component associated with it. So nearly you get around 3 times the amount while you are investing in PPF without using your brain, without falling into the trap of the salespeople, right? If you look at other plans, right, other plans, there are plans that will run up to 38-39 years. In another plan, they said you'll have to pay for 12 years, and 13th, 14th year we will not get any money, and for 15th year you'll get around 1,33,000, and at the end you will get a lump sum amount of 12,36,000 rupees. And the total, when I totaled it, it came around 45 lakh rupees. Oh wow, amazing return in 38 years, right? But when I calculated the IRR, it was just 6.1%. Just because the tenure is very high and the compounding takes place, you seem to get a higher amount, whereas if you invest that in a PPF or a EPF or a NPS, you will get much better returns compared to these plans. Now you would have understood that these plans are not great investment options. Now let us look at the second part, which is the insurance part. In insurance part, what happens is, in the first 10 years, you will have to pay, or first few years, whatever the construct is, you will have to pay a premium and there will not be any returns on this, right? And every year the amount of money that you are paying is 1 lakh, and the sum assured for 1 lakh premium that you are getting is 12,50,000 rupees for a 30-year-old healthy individual. Do not trust me? Let me give you an example. As you can see, in one of the plans, the brochure I have downloaded, you can see a healthy 30-year-old male with a lifelong income option of 50 years. If he pays 1 lakh plus GST, then the total sum assured is 12,50,000 in one type of plan and 10,50,000 in another type of plan, right? It sounds weird. If you go for a term insurance with a few thousand rupees, 10 to 15,000 rupees, you can get insurance coverage up to say 50 lakh or 1 crore depending on which company you are going and your age. And hence, from an insurance standpoint also, it's not a great insurance option. What are the problems that are there with this guaranteed money back plan or endowment plan or whatever you may choose to call it? The full amount doesn't get invested because a part of that amount goes into GST. 4.5% in the first year, and the subsequent year 2.25% goes to the GST amount. And not only that, it gives much lower return, sometimes much lesser than fixed deposits. Even when fixed deposit was at around 7%, these plans were giving around 5 to 5.5% interest rates, or IRR as you may want to call it. And it has a very long lock-in period which you may want to get into, while you can peacefully invest your money in a bank, in a fixed deposit or a recurring deposit or a PPF for that matter, or if you are eligible for a Sukanya Samriddhi Yojana, you can get still much better returns than going for these investment options. And not only that, they say insurance is one of the unique options of these products, but the insurance coverage is very poor. What's the point of getting insurance and an investment when both the options are very poor in such a product? How salespeople hide this information? Salespeople never talk about the rate of return. They only talk about the total money. In fact, when I was talking to the customer service executive or the salesperson who was trying to sell me this, they told me that I'll have to pay for 10 years, 1 lakh every year, and at the end, I'll get more than double my investment. Okay. When I asked for the rate of return, they said they'll have to calculate. And they calculated and told, they said it is approximately around 7%. By this, they create a perception of big returns. But in fact, it is not 7% because there is a GST amount. They generally exclude the GST amount and then they say, sir, you pay 1 lakh and you get 7% on 1 lakh. Whereas actually you're paying 1 lakh 4,500 rupees. Who will account for that additional 4.5% or the 2.25% every year, right? They never ever talk about GST, as I already told. And in case of some of the plans where they say bonus, they never will disclose the bonus, or they will not give an estimate of how much of a bonus you are going to get. So this is how salespeople really trick you into it. So the questions you must ask is, what is the rate of return? What are the additional charges? Next, why salespeople really push these products? Why are they doing this to us? It's very simple. They have a very high sales target pressure from the bank manager or from the regional managers till the bottom level sales executives, and they get huge incentives when they are pushing it. And the incentive is not going to one person, it goes to the entire loop. It is sold by a bank, but the product belongs to life insurance company. So life insurance company pays the bank and the person who is actually selling this, and hence because of these lot of cuts, the real investment goes down and the customers do not get good returns. I hope you would have understood issues about these guaranteed return plans and all. Now let us look at the ULIP. ULIP is also a very similar product. It has an investment component and an insurance component, but there is one change to it. The investment does not provide you guaranteed returns, whereas it is market linked. It is either invested in equity, debt, or a balanced fund where both equity and debt are also part of it. Very similar to a mutual fund, right? And very similar to a mutual fund, you get the amount in a NAV, that is net asset value, in units. Now there are so many charges associated with this ULIP. One biggest charge is the mortality charges. If you look at the mortality charges, this is the formula that people will apply. The charge amount per month is equal to charge rate multiplied by the sum at risk divided by 12. If and for a year you don't have to use this 1 by 12. Now if you look at the charge rate per year, let us say a person's age is around say 30, it comes closer to around 1.3, 1.4, and let's say the sum assured is say 10 lakh, then that individual must pay 1.4 multiplied by 10 lakh divided by 1000, which is around 14,000, right? And if the age is high, the charge rate is going to increase significantly. Let me give you an example. This is another company's ULIP product, right? And as you can see, the formula to calculate the charge rate, charge amount, and the charge rate for people who are at the age of 30 is around 1.77, which is much higher than what I quoted. And when you cross 40, it is going to increase significantly. So if your total sum assured is around 10 lakh, right, the amount that is going into mortality charges is 23,000 and the premium is close to 1 lakh rupees. Then imagine how much of money is going to get invested, right? It is going to be significantly less. Not only mortality charges are there, but you also have fund management charges, but fortunately it is capped by IRDAI at 1.35%. There are premium allocation charges, fund switching charges, policy administration charges, blah 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 blah, right? There are so many charges that are there that is part of this ULIP, and because of these charges, if you invest 100 rupees, out of 100 rupees, hardly 65 to 70 rupees goes into the investment, and the return that you are going to get is much smaller. But over a period of say 10-15 years, people have realized that ULIPs has been predatory and they have reduced many of the charges in the last year. In fact, some of the charges have been waived off. But still, if you compare this product with a mutual fund which is also market linked, this product doesn't really score well. If you compare mutual funds, the expense ratios are around 1.2%, and in case of index funds, it's much lesser. Whereas in case of ULIP, while the fund management charges are low, there are so many other charges which will go up till 10-15% in these days, and to some extent it is around 30%. So the amount of money that is actually getting invested is going to be much smaller. In case of mutual funds, there are so many options and the experts are way too many, right? Whereas in case of ULIP, the options are very less and the experts who are managing are not as capable or not as experienced and as a mutual fund AMC. If you look at ELSs, there is a 3-year lock-in period, whereas in case of many funds, the lock-in period is 1 year or lesser. In case of ULIP, you have a 5-year lock-in period. Mutual fund doesn't provide you insurance, but you can nevertheless get a term insurance for a much lower cost. While ULIP provides you a life insurance, it also has the problem of very high premiums for a very small sum assured, right? In this case, how salespeople will really trick you into is, they will say that you have a combo of, sir, you have a combo of insurance and investment product. Why do you and you do not have to worry about insurance, at the same time you do not have to worry about ATC, and with very high returns. When they say very high returns, they say it's around 20 to 25%. But the real issue is they never talk about charges. And when they say returns, which is around 18 to 25%, it is not on the amount that you invest, but the net amount minus the which is the total amount in you invest minus the charges. So out of 100 rupees if you invest, the returns on the 70 rupees, which actually goes for investment, maybe say 15% or 16%. Whereas if you compute it along including the 100 rupees, right, the total returns that are going to come is going to be much smaller, right? Finally, what should you do when salespeople come to you with these predatory products? First, ask them to show all the charges, right? Mortality charges, distribution charges, GST, everything. Ask them to show all the charges in a website or in a detailed product brochure. Ask for a detailed product brochure and terms and conditions. Second, ask the IRR, or you calculate it yourself. And when you ask for IRR, always ask IRR including all the charges. Generally, people exclude the charges and they compute a return and they will tell you very high returns. In fact, it is not the real case. So it's better that you calculate it yourself. You saw this in the video, how easy it is to calculate an IRR. So you better calculate it for yourself. Do not believe in everything they say, and most importantly, improve your financial literacy. And if generally people come to you with an endowment plan or a guaranteed plan or a money back plan or a ULIP, just please say no, I know about this product, right? Fine. Hope this video has been helpful, and hope this video helps many people in preventing themselves in falling into this trap of ULIP and these guaranteed money back plans. If you like this video, please share with your friends, your colleagues, and help spread awareness so that they also don't waste their hard-earned money, and they also go for good investment options. Please subscribe to our channel and help us grow. And finally, thank you for watching.